Hey there, everybody. Ryan Haley with Atlantic Shores Sotheby's International Realty and welcoming you back to the Running Real Estate Podcast. Super excited for today. I've got a guest that has been super influential to myself, to my wife, to our family, to our community. Somebody that we've known for a while who's been a friend, who's been a past client multiple times, who's been there to kind of be a confidant and guide us where we need to go. He was actually a training partner of Christie's years ago in the CrossFit days. So quite a bit of history here, and somebody who's been a business owner and is in the thick of business, is a man of faith. So I'm super excited to introduce you all today to Hal Carmean, who is the president of Creative Wealth Management. Hal, thanks for joining us today.
Thanks for having me, Ryan. That's quite an introduction. We do go back a ways.
It's been a while. I don't know how many years.
2008. I believe, is when I met Christy at the old CrossFit Ocean City, before CrossFit even really blew up out there. And then when I was going out on my own and opening up the firm, you helped us find the spot we're in. So it's actually the last spot we looked at, which turned out to be the best spot. I wanted the one on the ocean, but my wife talked some sense into me.
I remember that. Yeah, I remember.
It was a nice space.
It was a good spot with a great view. But you've really transitioned well. Obviously, off of 589 here in Berlin, close to Ocean Pines, and you've got a huge space. Last time I was over there, when I was on your podcast, about a year ago, maybe a little bit more than that, got a chance to see your expansion in your space, and you've got I don't know how much square footage you have there, but you got a very nice location.
Thank you. Yeah, that space has really treated us well. Centrally located for the majority of our Delaware clients as well. Right. I live in Delaware, and people ask me all the time, why don't you put an office in Lewis? It's a little bit shorter in terms of miles, but the time is double compared to what it takes for me to get from Delaware down to here, to Ocean Pines. It's a very easy ride. So that space is awesome. We ended up moving into what used to be the old NV Home space in there. And so they haven't been there since pre-08 going back. But they had it super decked out in there. So it was nice. A few modifications here or there, but that space did turn out really nice.
That whole complex where you're at, it seems like it's filling up a little bit, or filled up over the last few years.
It has. I know our building is completely leased out. They had someone new move into our old space underneath there. We do have one tenant moving out on our floor, which we will probably end up taking over, connecting those two offices. Yes.
Nice. So as I mentioned in the intro here, there's so much that we could unpack here today. So many different roads, that we could go down to talk about some of your specialties. It's like the man of mystery, the most interesting man in the room. When we were off camera here, we were kind of going through some things. I'm like, wow, I forgot that you did that. So maybe let's just start off with just a basic introduction. Who is Hal? You grew up here. Tell us a little bit about you, your family, your history in the area.
I wouldn't consider myself that interesting, but I do some interesting things and get involved in some interesting stuff. So Hal Carmean, I grew up in Georgetown, Delaware, moved away for college, and I remember leaving saying I would never come back to the Eastern Shore. This is a long time ago. And went to college, ended up going in the Marine Corps. Then after that, started in the financial industry. Right out in Center City, Philadelphia. And I remember working there in Center City, loving it. This country kid. I grew up basically on a farm in the city, and I just took to it. And then after about a year of trying to navigate there and get things done, I was like, you know what? Maybe it's time to move back. And my business and my clientele was taking me back down south. Here.
Okay.
It's where I felt the most comfortable. It's where I knew the most people, and it's where I was thriving the most. So I was living outside Philadelphia, but traveling down to Sussex County and Worcester County 3 times a week anyway. So naturally, business just took me back down here. So
right. Now, so, when you get into business or you get out of college and you decide to get into business, I mean, were you able to kind of tap into some of your roots as far as clients go? I mean, meaning like people you knew as a kid or business owners, and that helped you grow your business? Or it just naturally, this was where you were comfortable, so you kind of started looking for more business in this area?
I think it was a combination of both. I recall my father sitting down with me as I was entering into this business, and he had a lot of contacts, and he said, look, I'll give you some contacts and you can sit in front of them. That'll get your foot in the door, but I'm going to tell them they're under no obligation to do business with you at all. You're not getting any special favors. And that did get my foot in the door, but a lot of them didn't end up doing business with me at all. And some of them did, and it just developed from there. But a lot of our clientele has come from the relationships over the years and referrals. I mean, we are a referral-only business, so that is really our only marketing that we do. I believe very heavily in a service model, as you do, and I believe that sets us apart from a lot of different places.
Yeah. So, for our audience, obviously we have a fairly heavy real estate background audience, and for them to understand what you do, maybe you can kind of go into it a little bit, how you specialize. Because I remember, I think when we first met, it might have been about that time where maybe it was just after, where the world kind of transitioned from, in your business, the fee model versus service model, and financial advisor versus wealth management. And then, you and I kind of work together a little bit too with wealth management. The real estate kind of gets tied into that too. Right. So maybe you can help our clients understand here, what is your role? What do you guys do?
So that is a very good question. It's something that we are very passionate about. To be the disruptor in our industry. So my first 10 years in this business was spent, had great success, but no one really taught me how to build a successful practice. And I was always subject to what the corporate side of things wanted for that client. And I always felt there was a disconnect. Since I was a little kid, the discussion at our dinner table was, you eventually need to go into business for yourself. Come from a long line of people who've done that, not hugely successful in terms of monetary things, but we'd rather own a fruit stand on the side of the road if it's going to be ours. And every generation's been stubborn to not do what their father did in that aspect. So I always had those aspirations, but more so, I believe very heavily that there is a client-centric model that should exist where they come first. And there's a huge disconnect in our industry, especially on the corporate side, I feel, where that doesn't happen or has the possibility for that to happen. So going out on our own, when we started to plan this, 2010, 2011, I wanted to transition to strictly fee-based model where we really had two divisions, an investment division that if clients wanted to do business with us and have us invest their money in a fiduciary capacity for a flat fee, we would do that. But separate from that, anything outside the investment management, we felt that very strongly those fees should be separate, whether it's your traditional financial planning of retirement planning, college education planning, income planning, all of the bells and whistles that you hear out there from quote-unquote financial planners or advisors and things of that nature. We feel there's a conflict of interest when you integrate those two together into one fee, because then if someone in my business does the work up front on the retirement plan or financial plan, and the only way they get paid is if that client moves their assets and then they bill them on those, there's a potential conflict of interest. So don't get me wrong. Everyone doing it that way is not doing it wrong.
Right.
It's just we feel differently about that. And we don't want any potential conflict of interest there. But along with that fee, we want to be the source in that capital stack of advisors for that client, their CPA and their attorney who sits up top to coordinate all of that. So outside of the traditional financial planning, that's also real estate, which I'm sure we're going to get into, we believe very heavily in. It could be, where do we get our financing? Well, is it commercial? Is it residential? Are you selling a piece of property? Is it commercial, residential? Where is it? We need to bring the best expert for that particular deal to them. Is it buying a car? Simple as that. No one really likes to go in and negotiate that deal. we negotiate all of that for them. We just have them test drive and they show up and do it. So essentially, we are that client and that client family's personal CFO.
Right.
And we implemented that model a while ago when we first started, and we were slow to take traction on that because it is different. But what we found was once that client fully bought in, that we were their go-to source on every single financial matter. And if we didn't know the answer, we would get that answer and get them in front of the correct professional for that. Our relationships with those clients developed far beyond anything that I ever conceived could happen. And not just financial and friendships and things of that nature. And that's the part I really enjoy, being so intertwined with that client and their family in that decision-making process where we can aid them to be successful not only in their finances, but in life. I mean, there's a value and a price tag you put on stress.
Right.
The question I always get is, how much cash should we hold? Do we have too much cash? Well, there is a bare minimum that you should have in terms of expenses and months. But if a client holds excess cash, but it lets them sleep at night, that's okay that some of it doesn't earn as much interest. There's a value on that peace of mind. And that's what we're after to deliver to that client. And what we found as that evolution went on is that not only were we working with that client and their family, but we started to get their extended family. And one of my favorite times of the year when we have a client appreciation event, and I can look out and I see just groups of 12 or 20 family members, from brothers, sisters, fathers, mothers, sons, daughters, grandkids. I love that. I love doing that with clients. Are we going to be the best when it comes to the investment side every year, with returns in the up or down? No, but it's not necessarily about that. It's about being with them through that process and that journey throughout their entire life. And that's what we like. Now, is that the right fit for everybody? Not necessarily. And we're pretty upfront in our initial interview process with a client to decide whether we want to take them on or not, and them engage us also. If they're out there looking to double their money overnight, as the saying goes, and just purely at returns, we're not going to be a good fit for them. We do very well, but we're more than that, and that's what we're looking to do, to develop that relationship. So that's a little bit about our practice, which again continues to involve. I have a partner, a junior partner in Tristan, who is just amazing. I have a team behind that. It's awesome. I mean, they make that firm successful. My role has really transitioned to the macro level of overseeing everything, with Tristan running the day-to-day now on that. So.
Got it. Lots to unpack there. I mean, and it makes total sense because, I mean, when you really look at a family and their, it starts with obviously income, but then what do you do with that income, and every aspect of the wealth or lack thereof.
Right.
I mean, it's a lot of moving parts, and there's more to it than just the stock market and an investment going up and down. Every day, every decision we make could, impact our overall wealth. And unfortunately, there's just so many people that, they just kind of get up every day, they do their thing, and they don't necessarily, think about long-term wealth. So it's a extremely unique way, I think, of looking at, the overall big picture to help the family or help the client, wholly, as opposed to just one aspect of it. So you mentioned obviously everything you do, and you've got a great team to support you, and it's not for everybody, but it seems like your business has continued to grow ever since I've met you. You've got a pretty good growth trajectory. I mean, what is the plan for growth? Are you continuing to take on new clients now that you have some people that are working underneath you and they're building their businesses? What does that look like?
So we are in, there's a saying, if you're not growing, you're dying, but I think there's a caveat to that. So anytime we start to approach capacity for the service that we feel we can deliver, our deliverables, our package, when you become a client, we'll turn off the faucet of new clients. And we're strictly by introduction only or referrals. So we don't do any really outsourcing events where we're going to bring in someone that we don't know or has a connection. And we're in that mode now where we were approaching capacity and needed to expand to accommodate that. And plan is to continue to do that. So, Tristan's is young, but his work ethic and his ability to adapt in everything has just been great. And that's allowed me to take a step back and focus on where's the legacy of this firm. Eventually at the end of the day, what happens when I'm ready to retire or things of that nature. I have a duty and loyalty to our clients and our clients' grandkids who will be, in the full workforce at that point. And it's important that I help Tristan and this firm build a legacy that will be there for him to transition and eventually, take over the firm. I don't think I'll ever retire. I'd still want to come in.
How old are your kids again? You still got some young kids.
But we look.
Got a ways to go.
We look a year out, 5 years out, 10 years out, 20 years out. Those plans are already in place now. Now they'll be adjusted during that time period. But I just don't see a sale down the road in the open market. I don't. I want, my dream would be to transition that internally for someone to take over that has the same vision that I do with that and cares for the client. Mm-hmm. I'm involved in various study groups, and we'll go through case design and different things in the industry with, anonymously with clients and things. And we were talking the other day on a Zoom, and one of the gentlemen said, well, you share the same priority as us. It's clients are number one, and it's their best interest. And we kind of paused to think that in this day and age, we even got to say that,
right?
Where money's usually the focus. And that's what I want to see happen with the firm as we grow. So to answer that question, responsible growth so that we don't give up any deliverables to our clients. Mm-hmm. One of the reasons we build the way that we do and have our annual planning fee come out of their checking account essentially and not their investments so that they see that every month. I need them to feel that fee come out so that they hold us accountable and they are getting what they're paying for. Because if any time that client picks up the phone and says, what am I paying this monthly fee for you outside of my investments? I never want that to happen on that. So that's how we grow responsibly for that.
Got it. And obviously with the growth, you've been able to pick up, the growth in itself is just gone beyond stocks and bonds. It's everything in different aspects of their lives and their wealth. Which transitions into real estate a little bit. Obviously on the real estate side here, I know a lot of clients, not necessarily working with you, but clients that we have from out of the area mm-hmm. who will say they want to do something in real estate, and then they'll say, well, I got to check with my financial person. Mm-hmm. And sometimes the financial person comes back and says, well, real estate's not for you, or you shouldn't be doing something. So we kind of have this, not yin and yang, but sometimes it's the balancing act of we're real estate and then there's a financial person. But, since I've known you, and you mentioned growing up on the farm and land, and your father, who I've known and is an appraiser, real estate appraiser. So real estate's been in your blood since the beginning, and it continues to be a part of your, I think, the recommended advisement that you give to your clients that they need to have some real estate, and or if they're selling real estate, they need to be responsible with it. So tell me your thoughts on real estate. I know that's a lot there, but
if we were in a random conversation and real estate came up and you didn't know what I did, you would assume that I'm in the real estate business.
Right.
I grew up around it, live, breathe, eat, sleep real estate. So I'm a big proponent for that. And as my father always jokes and says, son, what you have invested for me is on paper. I get it. It goes up, it goes down. I can touch the paper, that's it. But a piece of real estate can go up and down in value. But I can go step on that land. I can feel the grass. I can feel the building. If there's something on there and the market drops 30%, I can put a tenant in there and produce income.
Right.
Can't really do that from that piece of paper you hand me. So that's not a big nod to the investment industry that I'm in and make a living with. But I am hugely a huge fan of real estate for the right client. Obviously, there needs to be certain net worth, certain emergency reserves, certain amount of limited debt that they may have. But it's an incredible asset class. People would say, well, it's illiquid. And I would say that's one of its biggest strengths, is the fact that it is illiquid and fitting into the right client's portfolio. I'm not a huge fan of tradable securities that are invested in real estate. Yes, they have their place, but they're more correlated than you think to the average stock market that you would say the S&P 500. And people can buy and sell them. And if they're liquid, someone panics and sells, that affects you. Mm-hmm. Where a piece of real estate that you may own, people are selling, real estate prices go down, but you can hold on to that. And you can produce an income from that with a tenant. You can refinance. You can do a lot of different things with a piece of real estate. And the illiquidity of it is actually one of its strengths. As strange as that may sound to some people, we love it for the right client inside there. So.
Yeah, the illiquidity piece of it sometimes makes you hold on to it a little bit longer, right?
That's exactly right. You have that invisible fence around that. Okay, you're not going to make an emotional sale of that when people are panicking or the market's going down. You know that, okay, this is going to appreciate long term, or it has a tenant in it that's paying any debt that you may have. Yes, they may come and go, but we've already assessed that risk based on what type of property it is. Is it a vacation rental, short-term rental, is it a commercial piece? Anything of that nature. So it's designed to go through the ups and downs inside there. So what I always say is about the illiquid nature of it, your money's still there. It's just in the walls or the piece of land. Now, I can't take that to the grocery store, but we're not depending upon that money to take it to the grocery store. So yeah, for the right client, I firmly believe it's a very good fit.
Right. And we agree. That's definitely one thing we agree on. So, for our clients right now, it seems like there's always a topic in the financial world. There's always something going on in the financial world. And maybe I'm a little short-minded sometimes where I'm only really thinking about what I'm thinking about, which is the most recent stuff going on in the news. But right now, it's an interesting time. Going back to pre-COVID, what we've experienced in the financial world in the last 3 years has been unbelievable. Lots of ups and downs and moving parts that aren't necessarily following the normal guidance that you would have. So, it has to make your job tricky, to say the least. I know you're investing for more longer term. You're not making knee-jerk reactions, but you have to be getting calls from time to time from people who are concerned as to bank failures, are interest rates going too high, what they should do. The volatility piece is amazing right now. Do you feel that you've had to field more calls than regularly, or what are your thoughts on all the moving parts?
The answer to that question is yes, but I would say yes. It's hard to quantify that as an industry average. Right. Again, we see our clients so much. Everyone's on a quarterly review schedule, so we're seeing them all the time, and most of the time I'm speaking with them in some capacity or someone from our firm in between that. Emails and things of that nature. So we manage expectations very well in that, and I write a weekly commentary with the subject matter being very relevant. So I'm addressing that ahead of schedule. But to answer your question, yes, that has been above average for all the years I've been in the business. For that, there's just a ton of information that's out there to process, from the banks to interest rates, and to tell you or to illustrate how crazy the financial world is. When in the history, excluding classic cars, has the value of a car not depreciated?
Right.
The last 3 years, used car prices have, they're a couple years old, have seemed to go above the sticker. That never happens, ever. It's a depreciating asset. Right. And that just shows you the upside down nature of what's going on out there in the financial world. So, I've been saying consistently, even before we opened this firm since 2009, that interest rates need to go up. Our expansion and quantitative easing, everything the Fed did after the crash in 07, 08, this isn't a talk on the Federal Reserve. I don't want people showing up in black suits to take me away, but their purpose to regulate that, the ebb and flow of our economy and markets, served its purpose in that. But we overextended. There was, I think, 1 or 2 small interest rate hikes from 09 up until last year. So the area of expansion, when we should have been incrementally raising rates to tame runaway inflation, did not happen until last year. And we did it all essentially in 1 year. And it just played havoc on the fixed income markets. So for years, we sat there with clients saying, how do we, even our planning, how do we mitigate interest rate risk? So if you have a low interest rate environment, the last thing you want to do on the investing side is lock up long term. Now, if you're on the borrowing side, not a problem, right? You want the low interest guaranteed forever. But on the investing side, if you purchase a bond, whether it's a government bond, a corporate bond, or whatever, the longer you go out in duration, the length of that bond, if interest rates go up during that time period, the value of your existing bond goes down. Right. The longer you go out, the higher that or lower that fluctuation will be with that, or lower it will dip. That's what happened to the Silicon Valley Bank.
The banks.
Their balance sheet or their assets were invested in long-term government bonds. I mean, the 20-year government note last year, grant me some grace on this, but a yield of slightly above 2% and finished the year down 29. Now, who wants that trade-off? I can make 2 or lose 29.
Right.
That's not a good trade-off. On what is the safest instrument in the world are government bonds. It's what backs up everything on that. So that's where they got in trouble, and where it's been very hard to invest on conservative assets because we've had to stay short term. So the way to mitigate that risk is you stay very short term in your fixed income allocation or bonds, so that if rates do spike, which they did, you're not in that bond for much longer, typically 5 years or less. But we saw there's an index for the S&P 500's corporate debt of all the companies in there. It's the corporate bond index of the S&P. It was down 15.5% last year. Its average duration was less than 7 years. That's almost short term. So very hard to do that. And for years and quarters after quarter, we sat there and said, we need interest rates to go up. We're going to forgo getting 2.5% long term to get 2 short term. But last year is a perfect example. And into this year, bond prices just fluctuated like crazy. So if you're an average company's 401k now has 8 options, it seems like. 2 bond options or conservative options other than the money market or fixed account, which for years paid 1% or less. If you're a participant in there and you're in their equity funds, again, this is just on average, you would have lost 20, 25%. On the fixed income side, you lost 15 or 16. It deters investment when that happens. And so that's why I don't like interest rate hikes like that being compressed into 1 year. So
what do you think? So you touched on the banks. You touched on the Silicon Valley Bank, and investing in those longer term government bonds. Do you think we've got other banks that are at risk still that played that same play in their investments?
Well, I'm not a doomsday
guy,
but this process. So let me talk about the positives of this. Is that it's making everyone aware that your money doesn't sit at that bank. It's not physically there, right? There's a reserve requirement of the bank. They loan out about 92% of that, 90 to 92% of that money. So they have an 8% reserve requirement, give or take. During COVID, that reserve requirement was 0. They could loan it all out. It's in your neighbor's house, your neighbor's car, your neighbor's business, your neighbor's debt, whatever it may be. So banks, it's good awareness for us to know how the banking system works. Now, for some, that will create a sense of panic, but that's how it's always been. Right. And that's how it will continue. With SVB, their primary clientele was so pigeonholed to tech startups that was the majority of their business. They don't need loans. They have an influx of money from venture capitalists. A bank, their deposits for a bank is a liability, because they have to pay out interest, whatever it is. An asset for a bank is a loan. That's how they make money, is when they loan out that money. So if a bank doesn't have customers to loan money to or don't need it, they've got to put that money to work somewhere. They chose to put it in long-term government bonds. Moody's considered that to be okay, gave them an A rating. Didn't turn out to be okay in that. So to answer that question, are banks in trouble? No. I mean, our financial system, if they are, everything we're talking about today is a moot point. Right. If that doomsday scenario were to happen, none of this matters on that. And I have faith in our system, 100%.
I think it brings up another good point, though. Like all of us who went through school and we learned, you learn math, you learn English. You don't necessarily learn business. You don't learn banking. You don't learn, like, it goes against your conventional wisdom. You think that it's a good thing for the bank to have more deposits, right? That makes that bank stronger. They've got so many people have deposited their money into the bank, but it's actually a liability. They couldn't do anything with it, right? So it's very interesting, and for most people, I think they just kind of move on and live their lives and don't necessarily, think about it until there is an issue or until there is some sort of headline, and then they don't understand it. So, and that's part of the reason I wanted you on here, was because there is so much, news out there. The headlines do more to terrify than they do clarify.
They do. It's what sells, Ryan. And FDIC insurance is great, right? It's our government backing up deposits at a bank. But if a bank goes under, you don't show up the next day with your hand out saying, "Give me my money."
Right. So when do you get that?
You could be a year.
Really?
Yeah. So it doesn't happen overnight like that. So it does bring awareness to that. Now, I will say the one thing that's different than, let's say, 30 years ago, maybe even less, 20 years ago, is that a bank could close up shop on Friday at 4. Mm-hmm. Think things over. Get a game plan to reopen on Monday if there's a run on deposits. Not that, again, I'm not a doomsday. Technology has changed that game. I can hop on my phone right now and Venmo you any money that I want. It doesn't matter what time of day it is or when the bank's open. So the electronic means to access that money is much greater. But it's our system. There's safeguards in place to protect that. And Moody's is a good rating agency. I just picked on them earlier in case this goes out too. People make mistakes.
Right. Nobody's got 100% the answer. You don't know the answer until 6 months after it happened, right? And you can look back on it. People used to say that all the time in real estate, going back to like 2008, 9, 10. It's like, oh, when's the bottom get hit? The answer was you could never time the bottom. You can never time the peak. You won't know if it was the peak, the bottom, the middle until 6 months, 7 months, a year later, when dust has settled and you kind of can really figure out where we stand.
Same thing with equities and the stock market as well. I mean, it holds true in real estate. You can't use your emotions to invest because your emotions are going to tell you to do the opposite of what you should do, when to buy and when to sell. I always say, emotions are a blessing from God, right? They serve us well. They let us feel happiness, joy, anger, sadness, and all of that. But they are a horrible leader, an absolute horrible leader. And you can't use that to dictate your investment philosophy. And it's your job, our job, to take the emotions out of that.
Right.
I have no emotional attachment to any investment whatsoever for a client. None. Yeah. I have a serious emotional attachment to my clients. I want them to succeed, but it doesn't matter. And that's one of the reasons that relationship works well, is because they may have that emotional attachment. They need me to say, it's okay, right? We can sell this or hold. Either way.
And that's what makes you unique. And I've seen it firsthand in the business dealings we've had together. I mean, when we've had mutual clients that you've referred to me, I mean, some of these people have lived in these homes. So if example would be, Hal says he's got a client that needs to sell a property. They're transitioning in life, and it's time to make a move. And you come to me and say, hey, Ryan, we need the house sold. Sometimes these people have been in the house for 30 years, 40 years, and they've got lots of, things there, and it's a process to move them. But I know that you are always looking out for their best interest based on what they can do financially to get them to the goal, to the end goal of where they really need to be. And I've always been able to sense that. I think that really sets you apart. And that's where, a client needs that, sometimes to take the emotion out or the yin and yang, to what they're thinking in their head.
I would say you'd be surprised, but you're not, because you deal with it all the time. But to the emotions involved in that process is very overwhelming for someone who has lived in their house for so long, watch their kids grow up there, their family develop, their kids move out, or whatever the case may be. Mm-hmm. Even if the financials of that deal, right, the house is appreciated so much, they're downsizing or moving, and they're going to make X amount of dollars. Not that it's always about that. Even with that involved, it's still a very hard process.
Absolutely.
And there's a bit of coaching there, but there's also a bit of grace and understanding, because I know what the numbers are, and I know the bottom line we can take. We're not shooting for that bottom line, but I know if we're getting close on deadlines of a new purchase and we don't want to have any debt or things like that, I know that we can take a little off of that price, get it sold, and still make out tremendously for the client. But for the client, every little single dollar we take off of the price they think it's worth, and there's nothing wrong with that, it's an emotional toll, right? Mm-hmm. Because they're so invested in that house, more than financially. And so that's a hard process to take a client through, and it's very emotional for them. But I like being there, enjoying that for that. It's not all dollars and cents when it comes down to that. So, yeah, it's I don't know how you do your job, to be honest. It seems selling the house seems like the easiest part. Getting to the table to close seems like the most difficult. There's a zillion things that can go wrong.
You're absolutely right. You're absolutely right. And I think it's having the vision, like you said, there's all the kinds of emotions that can go on, but it's the consistency to keep your eye on the prize, to keep the vision in mind and keep going back to that. There's going to be peaks and valleys along the way, but ultimately, we talk about this all the time. Real estate the last couple years has been emotional. It's been like, I want this, so it's a want-based market sometimes. But the true roots to real estate are more need-based and or life changes. Unfortunately, it's the D's. It's death, divorce, diamonds, diplomas. I'm missing one more here, but that's the kind of stuff that makes people make moves, and it can be tricky. But for me, and I know you're the same way, is that if you've got a client that is at a different part in their life now, and they know that they need to get to single level living, and it's going to make it easier for them, that's what we keep going back to. We keep going back to the end game. That's really, it may take some time to realize it, right, but that's where you need to be, and we keep going back to that, and just be very patient along the way.
Patience, definitely, because I know in any real estate that I've done with you, something always pops up. You've been very calming.
Yeah, I don't know.
When it comes to my own stuff, I
home inspections
tend to be impatient, but everybody else is patient with, I guess. I don't know, but yeah, I say it all the time. You can't put a price tag either on that area or that particular part of that process.
Yeah.
So anytime someone not complains, but says something about real estate commission, I'm like, yeah, it's too low. And they usually are like, what? I'm like, yes, you have no idea what's about to happen once we sign this contract. Right. There's a zillion things that could go wrong. This is why we pay him and his firm to do that, because we're going to get to the table. And it's the truth. There's so many variables out there.
There are. No, and that's life. You never know what the next day is going to bring. Hal, I really appreciate you coming in today and sharing with us. You fit right into what the purpose of this podcast is, and it's called Running Real Estate. So it's truly running a business. It's the ability to celebrate your family, your faith, your health, running, whatever it may be. So I appreciate you sharing your journey with us. For folks that are, have liked what you had to say about your business and how you guys do things differently than some others, what would be the best way to reach out to you?
Call into the office or, shoot us a message on the website. Our website's mycwmanagement.com. We're Creative Wealth Management in Maryland. Seek and you'll find us out there. Shoot us a message just to say hello. If you heard something on here today that you disagree with, man, shoot me a message. Please, do that. I'd love to hear a different side of that on it. I love people. So, yeah, shoot a message on there. And financial planning is simple. When you boil it down, there's only 4 places money can go: live, give, grow, and owe. You need money to live. That's what you spend. Whatever you give away, whatever you owe, and whatever you save. That's it. It's the only 4 places money can go.
Yeah.
And save, grow, same thing. All on that.
Well, don't give away your secret. You make it seem easy, but it's not easy. You do a great job. We really appreciate it. If you guys like this content, please like, share, subscribe. Check out Hal. Look him up. He's going to give you great advice, and he's been, like I said early on in the podcast here, he's been a confidant. He's given me great advice to myself, to my family, and we can't thank you enough.
Hey,
so,
we appreciate you greatly, Ryan. So not only personally, but when I refer a client and anyone in our office does, we know the job's going to get done well, professionally, and as best of your ability, and that's all we can ask for.
And we appreciate that vote of confidence. And once again, it's not just me; it's a team effort. We got Mary behind the scenes here. We have Rochelle in marketing. We have a great team of agents, and like you, we have a common bond where we strive to give the best service that we possibly can. That's what keeps us going every day. So, thank you for your time.
Awesome, thank you.
All right, guys, we'll see you again next week on the podcast. Thanks so much for tuning in. Take care.